Good evening, everyone, and we're sorry for this little delay. We had a computer problem right as we were about to launch, so we're up and running now. This is the March 25th edition of Bond Squad's Bond Squad After Hours broadcast. As always, it's brought to you by Bond Squad and Wealth Strategies and Management of Stroudsburg, Pennsylvania. Wealth Strategies and Management and Bond Squad are separate entities from Private Advisor Group. Private Advisor Group is a registered investment advisor. That's who handles all our investment advisory business. I'm wearing my bush hat from down under to celebrate the Kenya being down under 2% at this point. Close today at a 191, and that's kind of surprising because for the past year, the experts have been calling for higher interest rates, and it hasn't panned out that way. And now we're starting to see that the punditry out there is starting to acknowledge that long-term interest rates probably aren't rising very much, if at all, in the foreseeable future. Even Bank of America, or more correctly, Bank of America Merrill, the company that brought you the Great Rotation theory a few years ago, acknowledged that much of the money that's in fixed income will stay in fixed income. It's sticky. It can't rotate out for a variety of reasons, central bank, actuarial, demographic reasons. And it looks like the 10-year is going to be well bid for. BAML was even saying they could see it go down to 164. That's a bit aggressive for Bond Squad, but we would not rule that out in any way, shape, or form. And this brings us to a topic that we here at Bond Squad think is under-discussed, for lack of a better term. And that's the bond markets dots. We all know the Fed dots, the opinions given by various Fed officials anonymously, as it may be, about what their expectations are for growth, inflation, Fed policy, interest rates, and the market has been hanging on there every dot, as it were. But what does the bond market think? The bond market's made up of some pretty intelligent people, forecasters, traders, market participants. Some of us have been around the block a few times, and the bond market does give hints versus about what it's thinking and where it thinks rates might be somewhere in the future. And a popular Fed or bond market dot, as it were, are Fed funds futures. And if you look at the Fed funds futures, the rate that's on a Fed funds future, we can actually get a pretty good idea of where the bond market thinks various areas of the yield curve would be. So the first one is the Fed funds futures, right? That's where the market is trying to hedge or bet, depending if you're hedging or you're speculating, where the Fed funds rate might be at a given time. So when we look at the current future, the March 2015 future, it last traded at 0.115. Well, that's right where Fed funds rates are trading, so that's no surprise. When we go to the June 15, remember that was the popular liftoff. It's showing that the Fed funds futures trading right at 14.5 basis points, 0.145. All right, that's below the quarter that the Fed was thought to have as its first move. So that would indicate that the bond market doesn't think that June is a necessary liftoff. So let's go to September, which is Bond Squad's base case scenario coming into this year anyway. And we see the September Fed funds future at 0.26. So that indicates that maybe we're going to get liftoff for Fed funds rate hikes somewhere around that time. We go out, let's jump out to the end of the year, December 15, 0.425. So the bond market doesn't think that the Fed will go another full quarter by the end of the year. We would agree. We could see an eighth of a point move. We've seen eighth of a point or even smaller moves in the last 40 years from the Fed. So why not now? And Fed Vice Chair Stanley Fischer, possibly the smartest guy on the Fed or among central bankers at this point, cautioned investors that The Fed doesn't have to go in quarter increments, and it doesn't have to go at each meeting. And then it probably won't. So the bond market is actually taking that to heart. It's taking Mr. Fisher at his word. So when we look at the Fed funds future for the year end, it says 0.425. Well, our readers probably remember that we said that we believe that the Fed funds futures would probably not be over 1% by the end of 2016. Now that floored some people. We even had LPL's fixed income strategist Anthony Valeri, who's an acquaintance of ours, and we follow each other on Twitter, and I read his stuff, and I think he reads mine. He definitely reads my tweets, because when I said that on a tweet, he goes, "Wow, you're even more bearish than the Fed funds futures are." All right, so where does the Fed funds futures market estimate the Fed funds rate to be at the end of next year, December of 16? And it's 1.14. So we're one even is where Bond Squad thinks it should be. Now that's interesting, because before last week's Fed meeting, Fed funds futures were above 1.25 for December of 16. So everything's been ratcheted back. Now, what do we see that the bond market didn't see? I don't think we're that far off, Bond Squad and the consensus view in the bond market. I mean, is 1/8 of a point really that much of a difference in forecast going out? About 20 months, 21 months, as it were? Probably not. But that gives a good indication, though, that the market is not pricing in an aggressive Fed. So if you own floating rates, on especially LIBOR floaters, remember LIBOR floats off the Fed funds. On one hand, you're disappointed because you're not going to get a coupon raise. And remember, some of these calculated coupons on these floaters are below their floor, so you can get 100 basis points of short-term rate rise before those coupons move a basis point. So you might be disappointed there. We think you should be thankful, because a lot of these junk floaters, and we've seen some of these loans trading at 50, 60 cents on the dollar, so they're not really being priced to mature at par. We say, we're looking at the markets again today on it. But that could hold off defaults. Remember, what can happen is what happened in during the housing bubble, and that was rising rates often, or at least occasionally, but we'll say often in the last decade or so, results in higher defaults and delinquencies. Right? Your payment goes up. So what if these junk entities, and they're junk, remember, they don't have the strongest balance sheet, the strongest cash flows, they don't have reserve capital. What if their cost of finance goes up and they say, well, gee, when we had a 4% coupon, great, but now it's 5.5%. It's tough. Now it's 6%. We can't pay that. All right, creditors, here's the deal. We're going to give you 65, 70 cents on the dollar in new debt and stock. We'll call it even. Well, for a sophisticated junk player who bought the loans at 50 cents on the dollar, he's probably saying, all right, that's not bad. We'll take that. We'll take 60, 65 cents. For the retail investor who bought into loan ETFs and funds back in 2011, 2012, when the fund managers were paying par or higher for some of these, now the NAVs get hit a bit, and we're afraid that some investors might not understand this and might not like the outcome. But for now, we don't think interest rates will be a problem. We think regulation will be a problem when it comes to that, because the regulators are clamping down on these so-called leveraged loans. They can't get deals done. Spreads have widened. It's unaffordable. There's going to be an article in tomorrow's journal. Take it from us. There's going to be an article in tomorrow's journal discussing this, and it's not necessarily a pretty story. But back to the Fed and back to interest rates. So we know that the bond market is not forecasting higher short-term rates. Well, what about long-term rates? Remember, long-term rates, at least before the days of quantitative easing, tend to move with inflation pressures, right? So inflation's higher, long-term rates go up to compensate investors for the debilitating effects of inflation on purchasing power. All right. So if you're holding a bond for 1 year, and inflation's supposed to run at 2, well, then you want a 2-year. You want a 2% rather. But at that point, a 10-year might be 4%, right? Well, here's what the bond market's predicting for the 10-year, and we can go out as far as March of next year, and the bond market has a really aggressive forecast in the 10-year futures of a 285. But also has a 270 or 2.697 forecast for June of this year. Bond Squad says fat chance. There's just not going to be enough inflation in all likelihood to get long-term rates that high. We think there's a little bit of wishful thinking going on there, or maybe a little bit of aggressive hedging just in case. But I think disinflation is still the central bankers' biggest problem out there. We're not sure if we're going to see 285. Never mind March of 16. We're not sure if we're going to see it in March of 18 or March of 19. All right, you could see the 10-year not break 3 in this scenario. There's just not a whole lot of inflation. There's a race to the bottom. There's a race for jobs, a race for market share, and that all leads to lower inflation. So Bond Squad's forecast is for end of year for the 10-year to be probably around 2.25 on the high side. We think a range of 1.75 to 2.25 is a safe way of looking at it. The bond market's saying 280. Again, good luck with that. But even the bond market's more aggressive forecast doesn't forecast a 3%, which is not a historically high 10-year note, and it's a historically high yield for the 10-year U.S. Treasury over the next year. So the panic out there, and we hear it all the time. We even hear it in our own office. But Tom, we've been told that interest rates are going to go up. But Tom, we've been told interest rates are going to go up. You haven't heard it from me, and you haven't heard it from a lot of real fixed income professionals. You hear it from the mutual fund side, the equity side, the tin hat crowd on the newsletter side, which I guess technically we're part of that crowd now. But see, my hat's not made of tin or aluminum or any other metallic substance. But it's not the bond guys telling you that, and the problem is the people telling you these rates are rising also want you to buy products that will hedge you against that, hedge you against that rising rate environment, and everything's based on an annual return. Well, like we saw a Fidelity marketing research piece. That's not an oxymoron. We don't know one. But they had a bunch of good recommendations we liked, and they said, well, municipals probably won't perform as well as they did last year, so we don't know if we like them. Okay, guys, how many of you buy municipal bonds for a 1-year outcome? All right, we want you to email us, thomas.byrne@wsandm.com, and tell us how many of you buy for 1-year outcomes. If do you buy a municipal fund for that? No, you buy even a municipal fund, which we don't like, by the way. You buy for tax-free income, hopefully. It shouldn't be your total return speculation. The one exception was the summer of 2013 when retail panicked and hit the sell button on every muni fund on the planet, and the fund managers had to sell some of the better quality items out there. Yeah, maybe then that was a trade, but it was also a great time to buy and hold and generate income. Which brings us to our other topic. Buying and holding to maturity, having that ability, and that seems to be lost on people. Oh, we got to buy funds, and then we got to get out of funds, and we got to go back into funds. All right. If you're buying municipal bonds, or any bond for that matter, but let's keep it on the topic of municipals. Your primary goal is probably, or should be, tax-free or tax-advantaged income, right? All right, that means you don't want capital gains, and you probably don't want losses either, right? So if you have a portfolio of actual bonds, right, you have the ability to hold to maturity. So it doesn't matter. The price can go up, the price can go down, go sideways, it can do cartwheels. It doesn't matter. As long as that issuer is solvent, you're getting your return of principal at maturity, all right? No one can give you a forced realized loss if rates pop, because you don't have to hit that sell button and realize that loss. You also don't have to realize a capital gain that you don't want. The same is true when rates fall. The bond prices go up. Some people might want to take profits in their muni fund, right? Or for whatever reason, there's liquidations. People die. The estate sells the shares of the muni fund. The fund manager has to sell bonds. Sells them at a profit, you get a capital gain. Well, we had that when we visited a Smith Barney branch many years ago, where we had a financial advisor who was new to fixed income, starting his career out, nice, intelligent guy, and he's asking the right questions. But in this case, it was a little after the fact. He said to me, Tom, I bought this tax-free Pennsylvania Immunity Fund, but I keep getting taxable events, tax consequences. I said, yeah, you're getting capital gains because the fund manager, for whatever reason, is selling bonds at a profit. Only the tax-free income, only the income is tax-free, not any gains, trading profits, from the from any fund liquidations. So that has to be kept in mind. You're doing it's not that difficult to build a conservative or a moderately conservative municipal bond portfolio if you or your advisor or the fixed income professional they're partnering with knows what they're doing. You don't need a ton of money for it. Obviously, the less money you have, the more conservative you probably should be because you can't diversify as much. But you're seeing A-rated 10-year municipals trading 50, 60 basis points over 10-year U.S. Treasuries before taxes are considered. That's a pre-tax yield. Some cases you're seeing 3% still, in some of the in very good bonds. And that's before you factor in the taxable equivalent yield. So our message here is when you're venturing in the bond market, and if you're afraid of rising rates, don't stay in cash. Don't go into something else. If you need income, buy the bonds, ladder your portfolio, know what you own, barbell if you want to be a little more aggressive, and you have the ability to hold to maturity. And if you ladder, remember, if rates rise, your short bonds come due, and you could reinvest it at higher rates. If rates don't rise, or we get a flat or inverted curve, right, the long end of your portfolio locks you in at relatively high rates, right? You won't be caught down under. Yeah, that's the beauty of a well thought out portfolio. It becomes its own hedge. And for the life of us, we don't understand where this fell out of favor. Well, we kind of know why, because it's easier for firms just to say, yeah, pick a model, buy funds, and then they can't sue you. That's good, guys. So if you're an investor out there and your advisor's doing a cookie cutter like that, and you ask them why, and he says, well, because it's the most efficient way of doing things. We think that's a little bit lazy. Of course, it might be appropriate for you, but ask the question, why can't I have a portfolio of bonds and have the ability to hold to maturity? So, that's our suggestion here at Bond Squad. And the shape of the curve, we think, is an important consideration because it's our base case scenario that when the Fed starts to tighten, and we think it's going to be very gradual and very modest. But we don't think rates are going to move up in parallel, in unison. We think the curve's going to flatten. Now, it doesn't mean you're going to pop with long-term rates temporarily because the uninformed or the ill-informed hit the sell button on bonds, blow yields out a bit. But then the smart one will come in and buy it because inflation's probably not going to be a big problem. But the curve could flatten. And this is causing some concerns in the bond market. And we heard it twice. The past 2 days, Brian Kelly said it on CNBC, and Larry Kudlow reiterated it today. And what they said was there's a fear if the Fed tightens too quickly and prematurely, it could flatten the yield curve or invert it and cause a recession. We said hallelujah when we heard that, because for years, investors and advisors were incorrectly taught that an inverted yield curve predicts a recession. Bond Squad, and even back to our career at Citigroup and Schroeder and Wertheim Schroeder, have always said an inverted curve does not predict a recession. An inverted curve can cause a recession. It is the chicken, not the egg, or the egg, not the chicken, depending on which you think comes first, right? It causes the recession. Well, how does it cause a recession, Tom? Here, banks borrow short end of the curve, and they lend long. All right, so they borrow in the repo market, they borrow in the Fed funds market, they borrow in the LIBOR market, they borrow in the commercial paper market. They get that money, and they lend it to mortgage borrowers, corporate borrowers, or whatever, and they and they lend versus the 10-year Treasury, usually as a benchmark, right? So when the curve is positively sloped and steep, you can borrow, if you're a bank, at a much lower rate than at which you're lending. And you make that spread. That's the net interest margin, the NIM, as you might hear or see in financial publications, right? But when you get a flat curve, right, the only money you can make is that mortgage or loan spread above the Treasury. So if you have a 2.5% Fed funds rate and a 2.5% 10-year, and mortgages are 100 basis points over the 10s, that means at 3.5 you make 100 basis points. If you had a 1% and a 4%, that means you're borrowing at 1 and you can lend at 5, 100 over the 10-year. Well, that's 400 basis point pickup. If you have an inverted curve, right, and let's say you're at 2.5 here and 2 here, and you're 100 over that, well, you're only making 50 basis points. It might not be worth your trouble, to lend to, except for the best borrowers, the highest quality borrowers. You're going to make that little on your money. So in that way, what happens is lending dries up, business activity dries up, consumer activity dries up. So it's an inverted curve that causes the recession, and we don't believe that that's going to be a problem, but it's a legitimate concern. And it was refreshing to hear people actually say it correctly. They're afraid that the Fed causes an inverted yield curve, which causes a recession. Now, we think that's a little bit, far-fetched at this point, because even if the 10-year is where it is right now, 191, let's round it to 190, that means the Fed's going to have to go to about 2%, let's say, to invert the curve. We don't think the Fed would bring rates that high if inflation was low enough to where we had a 190 10-year. Okay? But as the curve flattens, it does make lending less lucrative, and everything slides downhill, as it were. So the first, or in this case, maybe uphill. The lowest quality borrowers can't borrow. Then the curve gets flat, it goes to the next best. Curve gets flat, it goes to the next best. Curve goes dead flat or inverts, and only the top quality borrowers can get capital, can get leverage capital, and that's a potential problem, which is why the Fed might be a little dovish here. So, the fixed income market is really not that difficult to understand if you just use a little gray matter between your ears. It really isn't, but you have to do a little thinking. It's not mysterious. There's no a conspiracy. Well, there were a few conspiracies going on in the bond market. We'll say that, but it's really straightforward. It's just common sense and logic, and simple math when it comes down to it. You don't have to be a rocket scientist with an algorithm to be successful investing in fixed income, but you have to have a lot of common sense. So again, our outlook here is that the Fed is very slow. We're still saying a September liftoff. We would not be shocked if it was later than that. We'd be somewhat shocked if it was earlier than that. We'd have to see pretty strong numbers, and the numbers are not coming in as such that would justify an earlier Fed move. That could change, and the numbers, the less than impressive economic data is not just because of the weather, and even the bullish economists are acknowledging that. So we think the Fed will have room to and space to be more patient, even without the word in their statement. September liftoff was our base case. About 3/8 of a point to 1/2 a point is our year-end forecast range for Fed funds. 1% by the end of next year. 2.5 to 2 3/4 by the end of the Fed tightening cycle, probably somewhere in 2018. At that point, the curve's probably flat or inverted, all under 3, or at least 2s to 10s under 3. And then we start the whole cycle over again. The Fed starts easing. We see very little out there that would justify that. If we see wage growth, yeah, but wage growth, we might have to see unemployment, the headline number. Remember, the labor force is smaller, and we have a lot of potential workers still sitting on the sidelines that, in theory, could come back. And then plus we have automation and efficiencies growing by the day. It could be that the Fed's new lower NAIRU, the naturally occurring, well, let's go with the neutral Fed funds, neutral wage growth rate neither adds to or subtracts from inflation. The Fed moved it down from 5.2 to 5.5 to 5% to 5.2. It's probably below 5. And the Fed will probably have to adjust it below that. The question is, can we get down that low? That's going to be a problem. So we don't see a whole lot of wage growth coming into play here. So what we're saying is, if you're nearing retirement age or in retirement age or need to meet certain obligations and you need that principal to be there, you might want to consider just building a bond portfolio, getting in touch with a good fixed income expert where available. There are other good ones out there as well. We'd like you to do business with us, but we understand there are competitors and there are a lot of good ones out there. Doesn't mean that you can't own equities, but as you get older, you can't risk that principal. So a bond portfolio makes a lot of sense to us. And with that, it is just about 8:30. We don't want to keep everybody here all night. We can keep talking bond theory if you'd like and go on and discuss other benchmarks and indicators of where rates are going. But we won't do that. We'll let you get on with your night. Again, if you need to contact us, our number at the office during market hours is 570-424-1555. And my email address is thomas.byrne, that's BYRNE, at WS, that's Whiskey Sierra, the word and, A-N-D, M as in Mike.com, WSandM.com. And with that, have a great night. Leave comments on YouTube if you like this video or if you don't like this video. And we're available for consultation and conference calls at any time. Thanks and have a great night.